Well, good morning, everyone, and thanks for joining us for another Simply Tax Talks, our live stream here weekly. And I think we've said it. Hopefully, you know it. We're going to be going through at least the end of 21, maybe beyond, depending on how long things wind up here. And of course, then we'll have to focus on unpacking and understanding how all this might play out for you. And again, really, that's why we do these live streams. It's to give you a chance to get your questions in, get them answered live. So use the comment feature. Don't be afraid to put that in there. I'll also mention if you have a question during the week, you can also email us at simplytax@bkd.com. We had a few questions that we've been getting in that we'll try to sprinkle in today as well. But I guess as we usually do, let's kick things off by having Yelena and Tad join us here from our national tax team. Excited to have you both here. Welcome.
Good morning.
I know we were chatting, getting ready for some turkey here in a couple days, but thought, what better way to get ready for that than to talk about what happened in Washington last week and some of the guidance we got. So let's jump into our first segment with our top tax takes. All right, Yelena, I'll start with you first here. We certainly did have a busy week last week, probably in comparison to the week before, which was particularly quiet. And as we talked about last week, at this time, we'd already seen the enactment of the infrastructure bill, but then we also saw the House voting on the Build Back Better Act. So, could you walk us through that and kind of where things stand and I guess what happened and maybe where we're going here?
Yeah, so the House finally passed the Build Back Better Act, which I know some people seem to think this means it's already the law, but it is not. As a reminder, the way a bill becomes a law is first it passes in the House, then it goes to the Senate. Once it passes in the Senate, there are changes made, goes back to the House, and they can either pass it or make further changes. And then once both houses of Congress agree, then it goes to the president for signature. So we're kind of like 1/3 of the way there. We have the House passing it. We're still waiting for Senate. And then Biden will probably sign whatever is passed by both houses. So the House passed.
I just want to reiterate your point there, Yelena, because I think that is a big point of confusion I've heard from many. So yeah, just to reiterate, right? It's not law yet, but we're a major step forward, I guess. Is it right? Is that how you kind of characterize it, I guess?
Yes, because we've seen multiple versions come out of the House of the bill. So this bill has been changing constantly. And so it's kind of good to have a touchstone that's actually passed the House. It has the agreement of all the House Democrats. I believe every House Democrat voted for it except for one who wasn't a fan of the SALT cap solution in there. So he didn't vote for it for that reason. But everyone else in the Democrats had agreed and passed it, which was a big deal because they've been negotiating this for months. And so for them to come to an agreement is monumental. But as a reminder, again, not only is this not law, but the Senate also now gets their pass at it. And we expect the Senate to make changes as well. And so, yes, we kind of have something to work off of, but we don't really know what it's actually going to be at the end of the day when it does become law, if it does.
Yeah. And, actually, this brings up probably one of our good questions that we've had in the email that we got. And it's probably a frequent I get as well that, again, so it's not law yet. So great distinction there, right? But is it true that tax rates aren't going up based off of what's in the House version of the bill? That's, again, just passed here.
Yes and no. So to kind of elaborate on that. So back when the House was negotiating the bill, the Senate Democrats were also involved in negotiations just because you kind of want to get all the parties involved while you're negotiating so there's no surprises down the road. And Senator Sinema said she's not going to vote on any bill that includes individual income tax raises or corporate tax raises. So that's what originally was in the first proposal that the House put through, which means they had to scrap all of those and kind of come up with maybe an indirect tax rate increase. So it's not increasing individual or corporate income tax rates, but there's kind of three different facets that may have an indirect increase on taxes. So first, there's a 15% corporate minimum tax, which is going to apply to corporations that have book income over $1 billion. There's a 5% surtax on adjusted gross income that exceeds 10 million. And then an additional 3% on top of that 5 if you have income that exceeds 25 million. And then there's also some changes to the net income investment tax. So that's also going to impact those making over $400,000. And so those are maybe not direct tax rate increase, but those are rate increases that will probably have a trickle down effect on overall tax rates.
Yelena, I think, that last one that you mentioned on the net investment income tax, it's a 3.8% tax. And historically, it's only been on investment income, hence the name net investment income tax. This bill that passed the House, it's kind of a stealth increase because now they're going to extend that to just ordinary income. So we have a lot of people have pass-through income, and they're in essence, reporting the tax from their trade or business on their personal return because of the pass-through. That income now is going to be subject to a 3.8% tax if your income's over 400, and quite frankly, most of the people are, because the income they're picking up from the pass-through will generally push those people over. So I think that's going to be kind of a stealth tax out there that's going to hit a lot more people than we're looking at right now. So we're going to follow that one pretty closely to see if the Senate has a similar provision in there. But again, that's one that's, I think we largely have been kind of not paying a lot of attention to, but I think it's going to hit a lot of people.
Yeah, it seems like a small tax, but it is one that has stayed consistent through all the proposals. So it seems like that's one that's kind of staying in there, kind of maybe a little bit hidden in a way, because, it doesn't seem like it's that much, 3.8%, and it's not going to impact everyone, but it's going to impact a lot of people. So yeah, that one is an interesting one.
That's a great point. Great point, Tad. And one that, kind of a stealth sleeper in there, but it's still, $38,000 for every $1 million of income for closely held. I mean, that's not an insignificant amount when you start adding, when you start thinking about what the dollars are. But I know another one. Well, go ahead, Ted.
Yeah. When you think about that, though, that's really not that big of a number to be reporting on your return. Because remember, this isn't your personal income, that you're reporting on the return. This is the income from your trade or business. And, we have, a number of clients out there who are well in excess of $1 million that they're reporting on their personal return. And it's really just the income of the company, that they're reporting there. And so now it's going to be subject to an additional 3.8% tax. And quite frankly, a lot of those people are going to be over that $10 million, but only because it's the trade or business income that's being reported there. So in a lot of respects, to me, that's kind of an unfair tax. And what it really does is it may get people to be looking at a C corporation, and I hate to say that because, I'm not a big fan of C corporations, but it will get you to look at that where the tax right now is a flat, 21% on there, and versus now you're paying 37 plus a 5% surtax, okay, plus a 3.8% net investment income tax. I mean, you're pushing 45 or 50% on that income. So if this passes the way it is, I think there's going to be some people that are looking at the C corps again.
Yeah, no, that's a really great point, Tad. And just in looking at the whole holistic picture, and even just the fact that, like you talk about the surcharges, I mean, they kick in at such a low level for trusts, 200,000, 500,000 for the 3% or the 5% and the 3% respectively. I mean, yeah, you're in there pretty quickly. And another one that I think kind of will impact a lot, maybe in a favorable way, at least in the near term, is the SALT cap. And I know there was a small change there as that went through, but I guess maybe Yelena, as we look at what's going to happen as we get over to the Senate, I would imagine the SALT cap maybe is one of them that we might see changes. But yeah, what might we see as changes as we get over to the Senate side, and what changed with the SALT cap maybe particularly?
Yeah, so originally the House proposal that we saw, kind of the pre-final one that passed, said that the SALT cap would be increased to $72,500 from $10,000 through 2031, through the end of 2031. And then last minute, they made a slight change and they made that $80,000 through 2030. And there's been some pushback from, this is kind of a controversial hot topic almost right now, because there's some studies that show that the SALT cap benefits wealthy versus not wealthy. And then you get into that whole debate. And so you have some senators, including Bernie Sanders and Bob Menendez, who are developing a alternative proposal that they're planning to push through once the Senate gets to this portion of the bill. But their proposal is probably going to be a soon to be determined income threshold. So if you're above or below that threshold, will impact what the SALT cap will be for you. And again, that's trying to help middle class taxpayers more than the wealthy. And so we don't really know what threshold's going to be, but that's probably the big one that's going to be negotiated. And then you also have Wyden. We've talked a lot about him, but he has a lot of proposals, tax proposals he's released in the last year. And he's going to be pushing to get some of those included. Some of them have already been included, like the stock buyback tax. But his billionaire tax is not included. There's a couple other proposals that he has out that he would like to see included. And so you'll kind of see some of that negotiated. And then overall big picture that we've been talking about is, they have to come to a top number and then be able to pay for that. So we've seen CBO and JCT scores on this, and it's almost paid for, close to paid for. If you argue like IRS enforcement, all of those to cover some of the gaps. Democrats are saying this bill is paid for, but the Senate may push back on that and say, we want to move things around on how things are paid for, maybe increase some of the taxes or kind of shuffle things around to make all that work from the numbers perspective. So we'll see.
Yeah, we'll see. It will be an interesting, it's short kind of a windup here. And in terms of, I guess what's on the schedule for the Senate. I mean, they don't have a lot of floor time left here. But certainly as we get out of the Thanksgiving break, it'll be interesting to see. Now, we did get a question from the guests here or the audience on what the likelihood of the nuclear production tax credit staying in the bill. I don't know, Yelena, I don't know what your thoughts are, but I believe that actually was in the infrastructure bill, if I'm not mistaken. And if that being the case, and then infrastructure bill actually went through in its current form already. So I don't know if you have any additional insight on that one, but I believe that's already part of enacted law. So I would say based on that, it has a high likelihood of staying because it's already in. Anything either of you would maybe add on that one? I know there's a lot in there. There's so much in, especially the infrastructure bill. I mean, it's what, 2,700 pages, 2,400 pages. It's a lot of pages in there.
Yeah, the closest that I'm going to get to nuclear production is maybe an ethanol plant. So I'm no help on that one, but we can certainly, get that answer for you if you'd like.
Yeah. We'll button that one up and see, but I believe it was an infrastructure bill, which raises a good point, right? So the Build Back Better, not law yet, not enacted. Infrastructure, yeah, it is law. That's a little over a week now since that's the case. So yeah, I guess maybe I'll we'll start with you, Yelena, and then get you to your take on the timing here. What's your prediction, if again, just our personal guesses, I guess, on what timing might look like for the enactment of, or I guess I shouldn't say the enactment necessarily, but things moving along with the Build Back Better piece. Do you think before or after Christmas? Maybe we'll go with that. Yelena, what do you think?
I think best case scenario before Christmas, but realistically maybe after Christmas, just because if you look at the Senate schedule, they're out this week for Thanksgiving. Next week they come back and they have the December 3rd government funding deadline. So to fund the government to avoid a government shutdown. And then after that, they have 10 working days before it's a holiday break. And so, they've been known to stay past their, ending into the holidays. And work on bills, but it depends. So we'll see. Yeah,
great one. Tad, what do you think?
Yeah, I keep hearkening back to the TICSA where, what was that, like the 22nd or 23rd, and we ended up spending the week between Christmas and New Year's, reading through a 2,000 or 3,000 page bill, which had significant tax provisions in it, and I'm not sure that this one's going to have any significance, but I'm probably of the view that it'll be a couple of days before Christmas. I think, just simply because work expands to fill the time available with these people, and I think they're going to take it right up to the limit, and they just want to get it done and not have to come back that week between Christmas and New Year's. So that's kind of my guess.
Okay, fair enough. Yeah, it's bringing back memories here, Tad, of the TCJA and enactment, and reading it as getting ready for the holidays and all that. So we'll see if we get to relive any of those here. Kind of a repeat of the cycle, perhaps. But all right, well, let's transition over to what I always like to get, and that's the takes from you, Tad. So let's get Tad's takes. All right, Tad, you have been a busy guy in the last, we'll call it 19, 20 months or so, whatever. I'm losing track now, with some of the wind up to the relief from the pandemic. And in particular, the Paycheck Protection Program that was created under the CARES Act, you have just been, I mean, I have to tip my hat to you. I mean, it's just impressive at how much you have digested and helped and advised and counseled on. But last week, in addition to all this excitement about legislative front of things, we saw some guidance on the Paycheck Protection Program that we've been waiting for, and specifically around loan forgiveness and the tax treatment there. So could you walk us through what we saw there and I guess why it really matters?
I can. What happened last week is that, the IRS issued 3 revenue rulings, revenue procedures, for the Paycheck Protection Plan. And actually one of them dealt with some of the other, grant programs and forgiveness programs, in the CARES Act and the CAA and the Protection Act as well. So what the issue was that we were running into in 2020 is that, we really didn't know when to recognize the tax exempt income from the forgiveness of the loans. If you remember back, kind of go back in history here, is that prior to the CAA, which was passed, I think, December 27th, there was a lot of question about whether the expenses that you paid with PPP money was actually deductible. IRS was drawing a hard line in the sand and saying it was not. Okay. Then the question became, okay, at what point in time, are those not deductible? And IRS came out with a revenue ruling, I think it's 2020-27, that said basically, look, if you have a reasonable expectation that your PPP loan will be forgiven, okay, then you cannot deduct those expenses, on your 2020 return, which was, a bit of a surprise to some folks out there. But that actually turned out to be a pretty good revenue ruling for us because, when the CAA passed, it was unequivocally said that you do get to deduct those expenses. And not only do you get to deduct the expenses, but the forgiveness income, which is tax exempt, gets to increase the basis in your partnership or S corporation, units or stock respectively. Initially the question is, well, why is that a big deal? It's a big deal in certain circumstances because your basis in your investment, be it the partnership units or the S corp stock, determines how much of the losses that you can deduct that are passed through to you. So if you don't have enough basis, you can't take the losses. Now they're carried over, until the time that you have basis or, the entity recognizes income. So what ends up happening is then the sooner you can get the basis, the better off you're going to be because you can take the losses. So there was some question then when in the 2020 filing season, okay, if, when can I actually recognize that tax exempt income and increase my basis? Do I have to wait till I actually have the forgiveness? Can I do it when I actually filed the forgiveness application form? We were kind of at a loss, but we took the position on, pretty much every return that we were going to use the IRS's earlier revenue ruling and just flip the table and said, look, you told us before, when it was to your advantage, IRS, that if we had a reasonable expectation that the loan would be forgiven, then we have to take into account all the tax aspects of the forgiveness. So we took that position on 2020 returns. And look, if we had an expectation, which basically was almost every loan, except there's a time period there where if you remember that loans over $2 million were subject to the audit, requirements of the SBA and all that other kind of stuff, that was subsequently dropped. But so we took the position on almost every loan that we could recognize that tax exempt income in 2020. And that gave our clients who had losses on there that were going to be limited by the losses, they got to take those losses, in 2020. Now, is that, we had a reasonable position to take on that point. But what the first revenue ruling did was it verified that. Not only did it verify it, it actually gave us, a whole bunch of options, 3 options really, as to when we could recognize that. So we could actually recognize that in one of 3 time periods, either as we incurred the expenses that we paid with the PPP money, we could recognize it, in the year that we actually filed the application, or 3, when the actual loan was forgiven. So you have a lot of different choices here. Now, the problem is for those folks who didn't recognize the forgiveness income back in or didn't realize that back in 2020, their return's already been filed. Okay, now this revenue, the revenue procedure that was issued does allow you to file an amended return. You have to go back and to claim the tax exempt income back in an earlier year. So you still have that ability. And I'll get to another revenue ruling they issued that talks about how certain partnerships, may be able to file an amended return as well. But this was really a positive development. Quite frankly, I was a little surprised about how, giving us 3 options like this, basically you can do it pretty much anytime that you want to do it. So it really was kind of a positive ruling that was out there. So, we're reasonably pleased that you're probably not going to have to file an amended returns. There might be 1 or 2 out there where maybe the client didn't feel, comfortable, taking that position. And now, we actually, can take it with having some backup there. Here's kind of a downside though, and maybe not quite a downside. The IRS did require that there's a consistency requirement here. So if you recognize in 2020, for example, the tax exempt income in that year, you have to recognize it for every other purpose of the code. And the primary purpose is it has to be included in your gross receipts. Gross receipts is a determiner in a number of different elections that you can make, cash basis, versus accrual basis. So gross receipts is referred to quite frequently. So if you pick this up back in 2020 as tax exempt income, then you have to increase your gross receipts back in the prior year. Now, the biggest notable exception to that, if you people who took the retention credit, that one of the requirements or qualifications is you have to have a 20% or more reduction in your gross receipts. Okay, but that specifically in Revenue Procedure 2021-33. Any gross receipts from the forgiveness of a PPP loan are excluded from the definition of gross receipts. So that's not going to be a factor as you go through on your retention credits. So pretty positive all around, on that. And again, that was Revenue Procedure 2021-48. Then they came up with another one, 2021-49. We're not going to spend a lot of time on that one, but basically that gave you rules as to, primarily for a partnership, how you allocate that income to the partners. As many of you are probably aware that one of the benefits of a partnership or an LLC structure is flexibility in allocation of the income to a point. It has to have, certain economic effect and those type of things. But so this revenue procedure, gave us guidance about how we can allocate that to the various partners, the tax exempt income. Basically, it relies back on a concept that's known as they will respect your allocation. The IRS will, and this revenue procedure says they will respect it, so long as it's in accordance with Section 704B or the regulations under 704B, and in accordance with the partner's interest in the partnership, which is a really nebulous concept to begin with, but basically, if you allocate it as your other income is being allocated under the terms of your partnership agreement, the IRS will generally respect that item. Then the final one they issued is actually kind of a nice one as well. There are certain partnerships that are what are called, Vba Partnerships, which basically means that they are subject to the centralized audit regime that was passed, I believe, in 2015 or sometime in that time period. And basically what, among other things, those partnerships cannot file an amended return. They have to file what's known as an administrative adjustment request, an AAR, which is a bit of a cumbersome form, I guess, to file. Well, the IRS actually gave us a break here. They said that if you are filing or need to file an amended return, or which would otherwise be an AAR, because you want to adopt, the 2021-48, the first revenue procedure that we talked about, then you can actually file an amended return as opposed to filing the AAR request. And the like I said, the positive news about that is it's much simpler to file an amended return. There are certain procedural requirements. When you file that return, you got to write certain stuff up at the top of the form, but it will certainly make things much easier. That's the good news. The bad news is if you're going to adopt that procedure and file the amended return, you have to do it by December 31st of 2021. So you basically got 6 weeks, to file that amended return. So not sure why they put such a tight turnaround time period on there, but they certainly did. And, it's a really positive item that you can do the amended return. And again, you can also, if you file the amended return for the PPP provisions of the revenue procedure, you can actually make some other changes, other amendments if you wanted to that were unrelated to, the PPP matters. So all in all, 3 really favorable rulings out there. So some
Absolutely.
walking
Yeah.
this
No, I
week.
appreciate walking through, but yeah, that action item before the end of the year, right? Another thing to add to the list, I guess, to
Right.
think about and look at and make sure you have right. So,
Right. And
yeah,
we have, I would just say, we did an internal write-up on this thing, and if they wanted to email to you the Simply Tax email site, we can certainly get a copy of that to you.
yeah. Let's again. I'm biased here, Tad, but your take on it, your summary here was really good. So yeah, I'd highly recommend and encourage it. But well, let's go ahead and get to our top takeaways for this week. And we'll also layer in probably a few questions. The first question I want to layer in, this is not one that we have in the chat, but one we'll maybe come back to, and that's Tad. Any updates on the ERC guidance on the early sunset of the ERC?
Have not seen anything yet. There was something that came out this morning. I haven't read through it that closely, but I think it dealt more with it was in the IRS manual about what the IRS was to look for in terms of 941s from back in 2020. But I have not seen anything yet on the deposit. I would still just echo what or repeat what I said last week. If you have an amount due, the sooner you get it paid in, the better your chances of abatement are if they don't do the blanket.
Yep. No, that's it's a good advice there, Tad. So, all right, Yelena, as we typically like to wrap up, what are you watching for in the week to come? Which obviously, I guess, bearing in mind that there's a recess and a holiday in there. What are you watching, and any predictions here before we get to the end of the year?
Well, Congress is out this week, so I don't expect anything new on the legislative front. The IRS will obviously be off closer to the end of the week, but they are issuing guidance. They've issued some stuff this week already. So I think more just on the IRS guidance front, just looking to see if they issue anything, whether it's on the ERC or the infrastructure bill. We've had a couple of questions like the infrastructure bill reinstated the Superfund excise taxes for chemical manufacturers, and we need guidance on how that's going to work. So keeping an eye on things like that more with the infrastructure bill at this point and what Treasury and IRS will issue to implement that.
Yeah, that's great. And Ted, there's a comment here from one of our audience members on so it's a CFO at a community bank. They have less than 10% of their 90 million of PPP loans left on the books. The rest have all been forgiven by SBA. And it probably tees up, maybe in our Simply Tax Talks next week. We talk a little bit more about what we're seeing, what you're seeing again,
Right.
in particular, perhaps on the PPP front and considerations and loan forgiveness and all that. Does it sound like a deal, Ted?
It does. And, just to maybe give a reply to that comment, that's fairly consistent with what we're seeing as well. I office in a bank, here in town, and, I had a conversation with, their officers, and again, it's mostly just some laggards, that they have out there, but that's great to see. That's pretty consistent all over the place.
Yeah, no, absolutely it is. So, all right. Well, there was one other question that we got in the email that I'm going to ask you real quick here, even though it's probably a little bit more of a in-depth question, probably one we'll probably continue to revisit. But, a lot of times this year or time of year, we get a lot of questions around placing assets in service and depreciation and the like, whether it's 179 or bonus depreciation. So I guess, Ted, I'll ask this one of you in terms of I guess, what's your advice on that at this point in time, kind of where things sit with Build Back Better in terms of whether or not you would maybe do that?
Yeah, there's a couple things here, that kind of flow each way. One, remember we talked earlier about the 3.8%, net investment income tax, coming into effect possibly, in 2022. But there's another thing out there that we really haven't talked a lot about, and that's the interest expense limitation under 163J, and the significant change that's going to happen next year. And that, before it was based upon the amount of interest you could deduct was based upon your EBITDA. In other words, you got to add back depreciation and amortization. to what your base was to determine your deductible interest expense. Well, effective in 2022, the DA part of that goes away. Okay, you do not get to add back depreciation and amortization. So to the extent that you can bring that back into this year in 2021 through either 179 or bonus depreciation, you may be better off. But you've got to take a look too about whether you would fall under that 3.8 and maybe the 5% surtax. So it's a bit of a situational type thing, but you do need to take a look at that.
That's a great point. And going back to just the things that happened under the Tax Cuts and Jobs Act, absent anything else happening, which is some of those provisions sunset and change. And, the EBITDA to the EBIT is definitely something we'll see. So great answer. And again, probably the most popular tax answer sometimes when you have uncertainty is it depends and you got to model it. So there you go, I guess. All right. Well, I think we've covered our bases for today. Want to, again, let you go on your way about getting off to giving thanks and celebrating to the extent you can with family and just everything else going on. So we're going to wrap it up for today. But of course, reach out to us, drop us an email at thesimplytax@bkd.com. Thanks to Tad, to Yelena for coming back on, and we'll see y'all back next week. We'll talk some PPP perhaps, and I guess what else is on the horizon as the Senate gets back into session and we see where everything goes. So thank you both. Thank you for watching and listening, and have a happy Thanksgiving.